Common stocks, the foundation of equity investing. Common stocks represent ownership shares in a corporation. When you buy common stock, you become a partial owner of the company. Each share of common stock represents a fractional ownership interest in the company. The more shares you own, the larger your ownership stake. Common shareholders have voting rights, giving them a say in corporate governance. This typically includes electing the board of directors and voting on major business decisions. Common stockholders may receive dividends, which are portions of the company's profits distributed to shareholders. However, dividends are not guaranteed and are paid at the discretion of the board of directors. In terms of claim priority, common shareholders are last in line. They have a claim on a company's assets and earnings only after creditors, bondholders, and preferred shareholders have been paid. Common stocks offer higher potential returns through price appreciation and dividends compared to bonds and preferred stocks. However, they also carry greater risk, as their value fluctuates with market conditions and company performance. Common stock prices can be highly volatile, rising and falling with market conditions, investor sentiment, and company performance. This volatility creates both opportunity for gains and risk of losses. To summarize, common stocks represent ownership shares in a corporation, giving shareholders voting rights and potential dividends. They offer higher potential returns, but also carry greater risk, and common shareholders have the last claim on company assets. Preferred stocks are hybrid securities that combine features of both stocks and bonds. They typically pay fixed dividends that must be distributed before common stockholders receive any payments. Preferred shareholders generally don't have voting rights, but enjoy priority in dividend payments and asset claims during liquidation. These stocks are less volatile than common stocks and appeal to income-focused investors seeking more stable returns with reduced risk. Growth stocks represent shares in companies expected to grow at an above-average rate compared to the broader market. These companies are characterized by their focus on rapid expansion and market share growth. Unlike other stocks, they typically reinvest earnings back into the business rather than paying dividends to shareholders. Growth companies operate on a reinvestment cycle. Instead of distributing profits as dividends, they funnel earnings back into business expansion, research and development, and market penetration strategies. Growth stocks are commonly found in innovative industries. Technology companies, biotechnology firms, and renewable energy ventures are prime examples where rapid innovation and market expansion create high-growth opportunities. Growth stocks offer a distinctive risk-reward profile. They typically exhibit higher volatility and are particularly sensitive to market sentiment and economic outlook. Investors choose growth stocks for their potential for substantial long-term capital appreciation, accepting higher risk for the possibility of greater returns. This higher volatility means growth stocks often experience significant price swings in both directions. While this can be concerning for short-term investors, those with longer time horizons can potentially benefit from the overall upward trajectory. Value stocks represent shares in companies that appear to be undervalued based on fundamental analysis. These stocks trade at prices below what their performance or assets would suggest, often having lower price-to-earnings or price-to-book ratios than the market average. Key metrics for identifying value stocks include the price-to-earnings and price-to-book ratios. Value stocks typically have lower PE ratios, often around 12 compared to market averages of 20 or higher. Similarly, their price-to-book ratios are lower, indicating the stock may be trading below its asset value. Value investors look for established companies with strong fundamentals that are temporarily out of favor with the market. These stocks typically offer higher dividend yields and potentially lower risk than growth stocks, appealing to investors seeking both income and price appreciation. Income stocks are shares in companies that pay consistently high dividends relative to their share price. These companies share several key characteristics that make them attractive to income-focused investors. Income stocks are typically well-established businesses with stable, predictable earnings. They often have limited growth opportunities, which allows them to distribute a significant portion of their profits to shareholders as dividends. A key metric for income stocks is dividend yield, which measures the annual dividend payment relative to the stock price. For example, if a stock trades at $50 and pays $3 in annual dividends, its yield would be 6%. Income stocks are commonly found in specific sectors of the market. Utilities are known for their regulated, stable businesses, with dividend yields typically ranging from 3 to 5%. Real estate investment trusts, or REITs, are required to distribute at least 90% of their taxable income, resulting in higher yields of 4 to 8%. Consumer staples companies sell essential products that generate steady cash flow, offering yields of 2 to 4%. When compared to growth stocks, income stocks typically show more price stability but less capital appreciation over time. Income stocks, shown in blue, tend to have stable share prices with modest growth. Their primary benefit comes from regular dividend payments, shown as green dots, which provide steady income to investors. Growth stocks, shown in orange, typically focus on reinvesting profits for expansion rather than paying dividends, resulting in steeper price appreciation but less current income. Income stocks are particularly appealing to specific types of investors. They're ideal for investors seeking regular cash flow, such as retirees who depend on investment income to cover living expenses. They also appeal to conservative investors with lower risk tolerance who prioritize wealth preservation over aggressive growth. Importantly, stocks with histories of growing dividends can provide some protection against inflation, as increasing payouts help maintain purchasing power over time. Blue chip stocks represent shares in large, well-established, financially sound companies with excellent reputations. These industry leaders are known for their reliable performance across multiple market cycles. Blue chip stocks typically demonstrate greater stability compared to the broader market, with steady growth and less volatility during economic downturns. Notable examples include technology giants like Apple and Microsoft, consumer staples like Coca-Cola, and healthcare leaders like Johnson & Johnson. Blue chip stocks offer significant benefits for investors: stability during market turbulence, high liquidity for easy trading, and moderate but reliable growth potential. These qualities make blue chip stocks core holdings in many investment portfolios and retirement accounts, providing a foundation of reliability and steady returns. Cyclical stocks, companies whose fortunes rise and fall with economic cycles. Cyclical stocks are shares in companies whose performance closely follows economic cycles. These stocks perform well during economic expansions and struggle during recessions. Cyclical stocks are found in industries like manufacturing, travel, luxury goods, and automotive sectors. The revenues and profits of these companies fluctuate with consumer spending and business investment. During economic expansions, these stocks can deliver strong growth, but when recessions hit, they often face significant declines. This brings us to an important investment strategy for cyclical stocks. Investors often buy cyclical stocks early in economic recoveries and reduce exposure before downturns. This approach requires careful timing and economic awareness for successful investment. Remember, with cyclical stocks, your entry and exit points can make all the difference in your investment returns. Now that we understand cyclical stocks, let's continue our exploration of different stock types. Section 8, Defensive Stocks. Defensive stocks are shares in companies that provide essential products or services with relatively stable demand, regardless of economic conditions. These stocks are typically found in essential sectors like utilities, healthcare, consumer staples, and basic necessities providers. Defensive stocks typically outperform the broader market during economic downturns and recessions, as their earnings remain relatively consistent even when the economy struggles. Defensive stocks are known for three key characteristics: lower volatility with less price fluctuation than the broader market, reliable dividends that provide consistent income, and resistance to economic downturns. In portfolio construction, defensive stocks serve as valuable components for preserving capital during market turbulence. Many balanced portfolios allocate 30 to 40% to defensive positions. While defensive stocks provide stability, other stock categories serve different investment objectives. International and emerging market stocks provide unique opportunities beyond domestic markets. International stocks are shares in companies based outside an investor's home country. Emerging market stocks specifically refer to companies in developing economies like Brazil, Russia, India, and China, often referred to as BRIC countries. The BRIC countries, Brazil, Russia, India, and China, represent some of the largest emerging markets with significant economic growth potential. International and emerging market stocks offer several key benefits to investors. First, they provide diversification benefits by spreading investments across different economies and markets, which can reduce overall portfolio risk. Second, emerging markets often grow at higher rates than developed economies, potentially offering higher returns. Third, these markets often have returns that are less correlated with domestic markets, potentially improving risk-adjusted portfolio returns. However, international and emerging market investments come with additional risks that investors should consider. Currency fluctuations can significantly impact returns when converting back to your domestic currency. Political instability is more common in emerging markets, where changes in government or policy can quickly affect market performance. Different countries have varying accounting standards and securities regulations, which may affect investment protection and reporting quality. Finally, emerging markets often have less stringent reporting requirements, making it more difficult to accurately assess companies. Understanding these unique characteristics helps investors properly allocate to international and emerging market stocks as part of a diversified portfolio. In the world of stock investing, companies are categorized by their market capitalization, commonly known as market cap. Stocks are divided into three main categories based on their market cap: large cap, mid cap, and small cap. Large cap stocks, with market values exceeding $10 billion, represent established companies that typically offer stability and often pay dividends. These companies usually have predictable business models and lower volatility. Mid cap stocks range between $2 and $10 billion in market value. These companies balance growth potential with established business models. They typically offer moderate growth and medium volatility, often representing businesses in their expansion phase. Small cap stocks, valued under $2 billion, offer the highest growth potential, but come with increased volatility and risk. These companies are often in early development stages, with emerging business models and less predictable revenue. When comparing these categories, we observe a clear relationship between risk and potential return. Each category plays a different role in a diversified portfolio. Allocation depends on an investor's risk tolerance, timeline, and financial goals. Understanding market capitalization helps investors build properly diversified portfolios and set realistic expectations for risk and return across different stock categories.